Are you ready to dive into the exciting world of investment options and make informed decisions for a healthier financial future? Well, you're in the right place. Welcome to Healthy Wallet, where we're passionate about helping you grow your wealth and achieve your financial goals. In today's video, we're going to embark on a journey of discovery as we compare two of the most popular investment options available, dividend stocks and bonds. Whether you're a seasoned pro looking to add to your portfolio, or just starting out on your investment journey, this information will provide you with the tools you need to build a healthy and diverse investment portfolio. So, sit back, relax, and get ready to learn as we explore the pros and cons of dividend stocks and bonds, and help you make the best investment decision for your financial future. But before we get started, make sure to hit the subscribe button and turn on notifications so you never miss a video from the Healthy Wallet channel. A dividend stock is a type of investment that is often favored by those who are looking to receive a steady stream of income. A dividend is essentially a payment made by a company to its shareholders, usually in the form of cash. These payments are usually made on a quarterly basis and provide a reliable source of income for investors. One of the main benefits of investing in dividend stocks is that they can provide a source of passive income that can help to diversify an investment portfolio and reduce its overall volatility. By receiving regular payments from the company, investors can rely on a stable and consistent stream of income, which can be particularly appealing for those who are retired or looking for a reliable source of income. Additionally, companies that pay dividends are typically established and well-established businesses with a proven track record of success. These companies have often been in business for many years and have a strong financial position, which makes them a more secure investment option compared to other types of investments. Furthermore, investing in a company that pays dividends can also provide the potential for capital appreciation, as the stock price can increase over time, providing investors with both a steady income stream and the potential for long-term capital growth. Bonds, on the other hand, are debt instruments issued by a company or government, and serve as a way for these entities to raise capital. When you purchase a bond, you are essentially lending money to the issuer in exchange for regular interest payments. The terms of the bond, including the interest rate, maturity date, and credit rating, are outlined in the bond's prospectus or offering statement. Bondholders have the right to receive the full face value of the bond at the end of its term, as long as the issuer remains in business and pays its debts. Bonds are typically considered to be a more stable and secure form of investment compared to stocks, as they provide a fixed rate of return and are not subject to the same level of volatility as the stock market. The regular interest payments from bonds can provide a steady stream of income for investors, making them a popular choice for retirees and those seeking to generate passive income. Additionally, bonds can offer tax benefits, as the interest payments are typically taxed at a lower rate compared to other forms of investment income. However, it is important to note that bonds come with their own set of risks. The issuer of the bond may default on its interest payments or fail to repay the bond's face value at maturity, resulting in a loss of capital for the bondholder. Additionally, fluctuations in interest rates can also impact the value of bonds. It is therefore crucial to carefully research the issuer of a bond and to understand the underlying risks before investing in bonds. Dividend stocks can be an attractive option for investors looking for a balance of both income and growth. While they offer the potential for both capital appreciation and a steady stream of income, they also come with some risks that should be carefully considered before investing. For example, there is a potential for dividend cuts which can impact the return on your investment. Additionally, dividend payments are not guaranteed, so it is important to research the financial stability of the company before investing in its stock. Bonds, on the other hand, are often viewed as a safer and more stable form of investment. When you purchase a bond, you are lending money to the issuer in exchange for regular interest payments, which can provide a predictable source of income. The interest payments on bonds are typically taxed at a lower rate compared to other forms of investment income, making them an attractive option for investors seeking tax benefits. However, it's important to keep in mind that bonds have limited potential for capital appreciation and are subject to interest rate risk and default risk. In the event of default, the bond issuer may be unable to repay the amount you lent, which can result in a loss of your investment. Ultimately, both dividend stocks and bonds have their own unique advantages and disadvantages. The type of investment that is right for you will depend on your personal financial goals, risk tolerance, and overall investment strategy. it is important to consider all of these factors carefully before making any investment decisions. When considering the right investment option for you, it is important to take into account your personal investment goals, risk tolerance, and financial situation. If generating a steady income stream is a priority for you, and you are comfortable with a higher level of risk, dividend stocks may be a good option. These types of stocks offer the potential for both regular income and capital appreciation, which can help to diversify your portfolio and reduce its overall volatility. However, it is important to keep in mind that dividend payments are not guaranteed and there is a potential for dividend cuts, which can impact the return on your investment. On the other hand, if stability and security are your main concerns, bonds may be a better choice for you. These debt instruments offer a fixed rate of return and are considered to be a lower risk investment compared to stocks. Additionally, bonds can provide tax benefits as the interest payments are typically taxed at a lower rate compared to other forms of investment income. However, it is important to note that bonds have limited potential for capital appreciation and are subject to interest rate risk and default risk. So I would say that the decision between investing in dividend stocks or bonds, or a combination of both, will depend on your individual investment goals, risk tolerance, and financial situation. By diversifying your portfolio and including a mix of both options, you can help to reduce your overall risk and increase your chances of reaching your financial goals. Wow, that was a great dive into the world of investing. Comparing dividend stocks and bonds can be a complex topic, but we hope you now have a clearer understanding of the pros and cons of each investment option. Whether you're a seasoned investor or just starting out, this information is sure to help you make informed decisions and grow your wealth in a healthy way. But wait, there's more. Our Healthy Wallet channel is here to provide you with all the tips and insights you need to take control of your finances and achieve your financial goals. From investing to budgeting and everything in between, we've got you covered. So, hit that subscribe button and turn on notifications now so you never miss a single video. And don't forget to share your thoughts with us. We love hearing from our community and value your feedback. So, drop a comment below and let us know what you think of this video. Your insights and experiences can help others in the same boat. Thanks for watching, and we'll see you in the next video. Until then, keep growing your wealth and living the healthy financial life you deserve.